Some people say that BDCs are way too risky and should be avoided at all costs. To that I say I want a number 2 with French fries, please. This is the video to watch if you want to know everything there is to BDCs on a 101 basis. And what you see on your screen right now are all of the different topics that we are going to cover in this video. So I've been using a bicycle as my main mode of transportation for the past 3 years, and I gotta say that it has been one of the best decisions that I have done, especially for lifestyle changes. My man tits went from here to what it is today, almost completely flat, which I think is not too bad. And on that note, I have a question for you. Why did the bicycle fall over? Well, because it was too tired. Alright, let's move along. Okie dokie. So what exactly is a BDC? Well, it stands for a business development company. You can think of a BDC kind of like a bank in that it lends money out to businesses in exchange for interest payments, a typical loan, or through equity stakes in their investment. If they give you this much money, then they're going to get a 20% equity stake in whatever business or startup that you're operating or running. But unlike a bank, a BDC is more hands-on because they have an investment team that specialize in operations, marketing, finances, whatever it is, and they give guidance and they help their clients' operations because a BDC succeeds if their clients succeed. So unlike a bank who just gives you that money and says, good luck, just pay us on time, a BDC will be in the trenches with you, formulating a new game plan so that you can open up another shop or to fine-tune your operations and your supply chain so that it's more efficient, you can increase your margins. A BDC does all of that. And it's worth noting that a BDC typically usually works with businesses that otherwise can't or won't work with a bank, a traditional mode of getting your loan. That is something to keep in mind. So in all case and purposes, you can kind of think of a BDC as like a private equity or venture capital firm that you can invest into. Private businesses that are not usually listed on the stock market. Sometimes publicly listed companies do go to a BDC for help, but 99% of the time it's going to be private businesses. And if it's still confusing, you can think of a BDC as kind of like an ETF that has a whole bunch of different companies within their portfolio. We're talking about 300, 400, sometimes even as high as 700 different businesses that partner with one BDC. So when you invest into one BDC, you're investing into a diverse group of sectors and industries like tech, medical, retail, a bunch of car washes, restaurants, etc. There's a lot to like about BDCs. Now let's go ahead and talk about the BDC pros and cons. The first really cool thing about BDCs are their very high and sustainable dividend yields. So their dividend yield is very high by design, at about 8 to 12% on average. That's the dividend yield that we are working with when we're thinking about a BDC. And for the most part, that dividend, it's going to be sustainable and very predictable income. And that's because a BDC, they have to pay out at least 90% of their income out as dividends by law. They're required to. That's the only way they can operate as a quote-unquote BDC. So when you think about it, the high dividend yield is a result of them paying out their earnings. So there's nothing sketchy or weird about it. Imagine if Microsoft or Google were paying out 90% of their earnings out as dividends. Then their dividend yield wouldn't be this 0.4% that we see today. It would be much, much higher. Well, that's what's going on with BDCs. And I guess the second really cool thing, as we just alluded to, is diversified exposure. Because when you invest into one BDC, you are basically investing into VU or the S&P 500, but for the private sector. But I do want to caveat that by saying certain BDCs usually have a preference for certain sectors. They'll usually have like a 30% allocation to businesses in the tech sector, and others, they prefer to work with the real estate industry and so forth and so forth. All the different BDCs have different personalities and perspectives and a strategy of what will garner the biggest total return for them, but also for their clients, but also for the dividend payouts. It depends on the BDC itself. And when we talk about the downsides, well, number one, Like most equity on the stock market, they are very sensitive to market conditions. If you open up a new tab or pause this video real quick and you go ahead and look up how Main Street Capital, which is one of the most popular BDC stocks, performs in the 2020 pandemic crash or in 2008, all that to say, whenever the market goes on a massive sell-off, the BDCs also follow suit and they go through that sell-off, dip, discount, correction, whatever you want to call it. All that to say, their volatility pretty much the same as the REITs, utilities, the tech companies. If they go on a sell-off, they're also going on a sell-off if it's due to market conditions and overall fear. Because during downturns, BDCs usually go on a massive sell-off because their industry, I guess for the most part, is inherently a little risky. Because think about it, their business model is handing out loans to businesses that otherwise won't work with or qualify through traditional banks, because of their credit score, or their business is, about to go belly up, or because the business itself is just way too leveraged and they already have too many loans to their name. And that's why when you think about it, some people are really good founders and inventors of starting a business, but when it comes to running the operations and scaling it, it usually takes a different personality and a different skill set. Some people are really good at starting companies, and other people are really good at sustaining and growing those businesses. That's where a BDC are experts in growing, scaling, and improving the operations. Whereas when they're working and partnering with a small business owner that is just getting their car wash business up and running, that has like 2 or 3 different locations, they might not have all of the business foundations and fundamentals down. And before I lose your attention, I do want to say that even though their share price usually gets absolutely crushed and demolished like all of the other equity stocks, when there is a macro environment condition that causes the stock market to go on an overall selling spree, the high quality BDCs usually continue paying the dividend business as usual. When we talk about the crappy ones, yes, they're going to cut their dividends, but also there's crappy dividend paying stocks out here that cut their dividends as well. So BDCs, not all of them are going to be beautiful, sexy, with cheese and Parmesan and pepper jack. Some of them are going to be ugly, smelly, and disgusting. You want to avoid them. But other BDCs that are high quality, even if their share price is tanking, their business and fundamentals that they're doing behind the scenes going to be business as usual, and you're going to continue to receive that 8, 9, or 10% dividend yield as usual, on time, like clockwork, like your hairline receding once you turn 45, 46, 47. And something else that kind of sucks with BDCs, as mentioned right here, shares dilution. Just like REITs, because they have to pay out at least 90% of their earnings out as dividends, BDCs usually raise more capital by issuing more shares, because you need more capital on hand in order to grow the business and expand your footprint and to hire more staff so that they can handle more businesses under their umbrella. So unfortunately, when it comes to BDCs, diluting the shareholders is a thing by design. However, if they're doing all the right things, their net asset value should be increasing, which means even though there's more shares outstanding, each share should have more NAV per share. We'll talk about that here in a little bit. And the last thing that I want to say that kind of sucks about a BDC is it doesn't matter if the BDC is externally or internally managed. My preference is to have an internally managed team. That way, the stakeholders, which is us, the shareholders, and the management team, we're seeing eye to eye. When an externally managed team is operating a BDC, usually they're going to be operating with their bonuses and end of the year fat checks with that in mind rather than thinking of us, the shareholders. So, meaning, hypothetically, and I'm not saying this happens all the time, but for an externally managed BDC team, they're going to be signing on more businesses left and right because they want to meet their quota and just to bring more businesses under their books. Whereas hypothetically, an internally managed BDC will be a little more thorough and examine the businesses with a little bit more strictness before just signing them into their team and umbrella to join their portfolio of businesses. All that to say, it doesn't matter if the BDC is externally or internally managed, the BDC is going to charge a fee that gets baked into its total return potential. But even after the fees, you're still left with at least a 10, 11, or 12% dividend yield. So I don't think it's the end of the world. However, if there were no management fees baked into a BDC, dude, the dividend yield that you would get would be higher, like 15 or even 20%. However, management fees eat away at your return potential. That is something to be mindful of, but dude, are we really going to be complaining when you're getting at least a 10% dividend yield? So I don't think it's the end of the world. And to be honest with you, externally versus internally are pretty much the same across the board, although the best pound for pound objectively speaking, BDC is internally managed. But it doesn't really matter because number 2, number 3, number 4, I think are externally managed and they're just as good. So take everything that I just said about internally versus externally managed BDCs with a grain of salt. They seem to do about the same in terms of performance. It's one of those things where on paper, the internally managed BDC sounds a lot better by definition and what they're doing, but in the real world application, how it plays out in actuality, it doesn't matter. Internally versus externally, they do just about the same, and I would argue sometimes the externally managed ones crush the internally managed ones, so all that to say, let's just move on. Now let's go ahead and talk about the tax implications with a BDC. You like my stack of coins that you see on the bottom right? Does anyone even use coins anymore? I feel like almost everybody, except if you're a stripper or a waitress, I feel like almost everybody now uses a card or a digital payment platform like Samsung Pay or Google Pay or Apple Pay, right? I don't know, maybe I'm just being weird. All right. Tax implications. And to do that, let's go ahead and look at a BDC's dividend profile. We're going to be using Blue Owl Capital, ticker symbol OBDC. And as you can see on your screen right now, their current dividend yield is about 11.3%. I don't care who you are, if you shower naked or not, or if you wear a little shower cap, dude, an 11% dividend yield, that is bonkers. That is an absolutely juicy dividend yield. So you might be thinking to yourself like, what's the catch? It sounds too good to be true. And I hear you, right? You might be thinking to yourself, this dividend yield sounds about as legit as a Nigerian prince emailing you asking for donations for his kingdom, in that you will have royalty if you do. And on that note, I want to give a quick shout out to be careful of the YouTube comments section. There's so many bots and scammers just running around rampant. It absolutely drives me up the wall. Every so often, I'll get a phone call from someone telling me like in a very thick accent, I'm talking about the one in Asia, not the Native American Indians, but the ones in Asia, very heavy accent saying, dude, you need to pay back your student loans. And it's like, are you stupid? Sometimes I play along and I'm like, how much do I owe you? They're like, oh, it seems like right now you owe us $50,000. But the catch is, dude, I went to a military academy, free. I didn't pay anything. I didn't take out any loans. And they're trying to convince me that I have to pay them. All I'm trying to say is anybody that makes a living by being a scam artist or by deploying spam bots all over the YouTube comments section, dude, I hate you. You're a jerk. You probably have really small nipples and a small pee-pee to match. Because I don't know about you, but I always think about why is this so prevalent and why is there so many people trying to be scam artists all over the internet? Because it probably works, right? I think about that 91-year-old grandma who is tech illiterate and one of these jerk-offs calls her saying, hey, you owe us, XYZ amount of money, which is probably her entire life savings. And she doesn't know any better. And she probably wires them all of her life savings, a 91-year-old. And as a result, she has to live in the rest of her days out in poverty. And it pisses me off as these jerk-offs and wherever they're from, they high-five each other saying, yeah, we got another one. Like, it pisses me off, dude. Okay, we need to change the topic. We're talking about BDCs. What's the catch with the high dividend yield? Well, that high dividend yield is going to be taxed at your income bracket, unlike qualified dividends. Because the dividend payout is so high, I think you still walk away with more dividends than a qualified dividend at like a 3% yield, right? For most qualified dividend payers out there, it's usually like what? 2.5, maybe 4%. So are we really going to turn down a pay raise at work just because you owe more taxes? That's how I think about it with getting more dividend payments through a BDC. Let's get real with ourselves, right? You would happily accept a pay raise at work knowing that it's going to bump you up into the next tax bracket and you have to pay more taxes on it. Likewise, with the BDC paying you more money at a 10% yield, dude, you're going to be happy. So assuming that you have about $100,000 invested into a BDC, on average, typically they pay about a 10% dividend yield. Yes, they're taxed at your ordinary income. And in the US, the median income, household income, is about $78,000 right now, which not bad at all. That's pretty high. And so we're going to assume that somehow you found someone to settle with you. You're fat, you're ugly, you're balding, but they decided to settle down and marry you. So for your taxes, you're doing married filing joint. And you have $10,000 rolling in through the BDC dividends. That means what? The total income is about $88,000. That $10,000 though, the BDC dividend payments, it's going to be taxed at a rate of 12%, which means how much dividends you get after the taxes is going to be about $8,800. It's still a pretty picture. I think that's still great. Now, on the other hand, with a normal stock that pays a qualified dividend, all else being equal, your median household income being $78,000 and you getting $10,000 in dividends, well, as you can see on your screen right now, that would be taxed at a rate of 0%. 0%. Dude, that's why dividend investing makes so much sense to me. And even if you make $115,000 or even $140,000 a year, dude, those dividends are going to be taxed at a rate of 15%, which I still think is not bad. I think that's phenomenal to have a passive income that's working for you so that you don't have to just work at your day job, but to have your investments be paying you. Phenomenal. But to keep going with this example, if the dividends were qualified, for example, if you have positions in American Water Works, PepsiCo, and McDonald's, well, those dividend payments are going to be qualified as long as you are a long-term investor, which means you're going to be pocketing the dividends at $10,000 minus whatever your country or state taxes you for their part of the deal. Doesn't that kind of suck? You do all of the work, you did all of the research, the homework, the due diligence to decide these are the companies that I want to invest into, and then you get your dividends, and now your state or your country or your whatever, they start taxing you for their end of the bargain. It's just like, dude, you suck. But, we got to pay the tax man. So as you can see on the screen right now, you would get $10,000 in dividends after tax, but realistically, it's probably going to be closer to like $9,200, but you get the point. And on that note, you know what really drives me up the wall? The fact that if you own property and you buy a house and you've been living in that house for like 20, 30, 40 years, why in the hell do you still have to pay property taxes for something that you own? That's your house. Why do we have to pay a tax on it every single year? I get why we do. That tax money funds the police officers, the firefighters. It helps the public school education. I get it. To improve the road system. I get all of that, but it's like, it drives me up a wall that you have to pay property taxes. And I don't even know because I've been living in an apartment or rentals my entire life. But one day, dude, I have a dream. Okay, hear me out. I want to buy a house one day. Will that come to reality? At this rate, probably not. I barely get, 500, 600 views a YouTube video, but maybe one day it will come true. But realistically, $100,000 invested into qualifying dividend payers would probably yield something closer to 3%, as we talked about earlier, right? It's not going to be a 10% dividend yield. I can't think of any qualified dividend payers that are not going to go bankrupt in the next 365 days that have a 10% dividend yield. Which means with $100,000 invested into qualified dividend payers, you probably will likely yield $3,000 in dividends. That's the more realistic picture, especially after taxes and everything. And that's why right now, I just want you to be honest with me, because I know on your state driver's license, it says that you're 6'2", but you're realistically 5'9" on a good day. You are a liar, good sir. Just be honest with me. Would you rather want $3,000 from qualified dividends? Or would you rather want $8,800 through the BDC dividends that aren't qualified and you have to pay your income bracket taxes on it? Be honest. Unless you are a pathological liar, most of us picking the BDC dividends every single day of the week except maybe Saturday. Saturdays, we get a little clumsy with ourselves, but we would rather prefer the $8,800 dividends from the BDCs. And that's why BDCs are an absolute favorite among the dividend investing community for that retirement income. Yes, a 2% or a 3% dividend yield is nice and everything, but an 8 or 9 or 10% dividend yield that is sustainable and is high that way by design, sign me up. Where do I go? Just sign me up. Now let's go ahead and talk about BDC recommendations. What you see on your screen right now, these are all the BDCs that I would personally recommend based on their performance and fundamentals. If you're looking for a place to start researching BDCs, I'm telling you, any one of these three right here, great place to start, fantastic. And out of this group of three, I would argue Main Street Capital is the best. A close second place would be Ares, and then Blue Owl is running right behind them. So if I had to categorize them, Main Street Capital obviously is going to be S tier. They are the king BDC for a really good reason, believe me. And then Ares, an A tier, maybe like a B. And then Blue Owl Capital, a solid B BDC, which to me is really good. Even companies that I categorize into the C tier as a grade letter, dude, that's not bad at all. That means they're average. That means all of their financials, fundamentals, and operations in line with what that company should be doing to be a C tier. So if you don't understand, I'm trying to say that Blue Owl is phenomenal as well. And when you look at their historical dividend yields, something that I do want to mention is Main Street Capital, their dividend yield usually fluctuates between 5 to 7%. And that's because their share price usually outpaces that of their dividend yield and the growth thereof. And that's why their yield is quite low for a BDC. So when you invest into Main Street Capital, it's kind of like investing into a growth BDC, because for the most part, BDCs, their share price is usually stable. It grows at a very small rate, whereas the dividend is the money maker, is the attraction, is stable, is sustainable. But I would say their dividend yield is pretty similar to that of a REIT, a solid REIT. Because of REIT, their dividend yield usually ranges between like a 3 to a 6%. So Main Street Capital, kind of like in that category. And with ARK, otherwise known as Ares Capital, their dividend yield usually around an 8 to a 10%, but for the most part, historically, for the past 15 years or so, 9% dividend yield. Sustainable and is usually around that ballpark number. With Blue Owl Capital, their dividend yield goes from about 10 to 12%. Remember, right now it's sitting at 11.3%. Pretty juicy. BDC Investing Strategy. So unlike other stocks, share appreciation, as I just mentioned, it's not really a BDC's calling, except for a few outliers, I would say Main Street Capital and a few others. So what I'm saying is a BDC, they usually trade near their NAV or book value per share price. Net asset value, book share in the context for BDCs is the same thing, semantics. So when you see a BDC near their 52-week high and trading for a premium that's way above their book value price, I would say be patient. Only dollar cost average into BDCs when they go on the dip. So the first investing strategy point is please do not overpay for a BDC. It is not a growth-oriented equity. And investing strategy point number 2 is to avoid the BDCs with inconsistent dividends. Because remember, the dividend itself is the result and output of their financials and fundamentals and operations going well, because 90% of their earnings are paid out as dividends. But if the dividend is shrinking or decreasing all the time, that says a lot about that company, that BDC, and their operations and what kind of ship they're driving. For example, what you see on your screen right now, Prospect Capital, ticker symbol PSEC, a very popular BDC. It's been shrinking its dividend payout slowly over the past 10 years. As you can see, back in August of 2016, Prospect Capital used to pay out 8 cents every single month, but since then, it's just been shrinking and they've been relatively flat from 2018 all the way to 2024. And now their dividend payout shrunk again, and now you can expect about 4 pennies every month. That is a BDC that you do not want to go near. Yes, they seem cheap, but it's cheap for a good reason. Just because a stock is cheap, it does not mean that they are undervalued. Sometimes they're cheap for a good reason, and that's because they are crap. If you're investing into Prospect Capital, I'm sorry. I already know you're going to click dislike on this video, but it is what it is. Objectively, they are not a good BDC. Moving on with some more BDC investing strategy tips. If you're trying to create a high dividend income retirement portfolio, most of us, we want a dividend yield that's at least like what, 4, maybe 5%. And because a BDC's dividend yield is usually around 10%, they'll help that average out. However, I wouldn't go as far as to say to only invest into BDCs. If you're thinking about that, don't do it. I think a healthy mix of like SCHD, a few REITs, some stable individual blue chip stocks such as water utilities or grocery food businesses should make up the bulk of your portfolio. And then a BDC should be about 10% or less of your overall portfolio. And if you live life on the edge, then I guess you could bump it up to like a 25% allocation of your investments. So the third point is, even if it's tempting, limit BDC portfolio allocation to under 10%, up to 25%. Please don't be that crazy guy that has all of his money into BDCs. Don't do it. Because even though right now, relatively speaking, as a sector in the BDC world, they're kind of safe, not exactly the safest like bonds, relatively safe. You do have some crappy BDCs operating like Prospect Capital. Dude, their stock price dipping, their dividend payout dipping. So if you invest into BDCs like that, you have the potential of losing all your money in retirement. But if you go for the high quality ones like Main Street Capital or Blue Owl or ARK, you'll be fine. But remember, I want to mention it one more time, their business model is inherently a little risky because they're in the business of handing out loans to businesses that usually don't qualify to work with traditional banks. So that business model itself, if everything goes wrong, yeah, it's a little risky, wouldn't you say? And the last BDC investing strategy point that I want to mention is do not chase the dividend yield. I think there's BDCs out here, their dividend yields go up to like 15 or even 20%. And to that I say, even in the world of BDCs, there is such a thing as yield traps. Remember, the healthy range for a BDC dividend yield is usually around an 8 to about 12%. If you see a BDC that's paying like a 30% dividend yield, it's because their share price is getting absolutely crushed and demolished. So instead of chasing the dividend yield, when you evaluate and research BDCs, look at the financials, the fundamentals, and historical performance, because I think that really matters when it comes to BDCs. If they're conquering all three of those categories, usually the dividend is going to be sustainable and it's going to be growing and it's going to be juicy and healthy. Because honestly, the question that I want to ask you is, what good is it for a BDC to pay a 20% dividend yield if your investment in them shrinks over time because their share price is getting crushed and is decreasing year over year? That 20% dividend yield is a trap. So the point is to look at a BDC's fundamentals first and then their dividend yield second. And using Blue Owl Capital as an example again, right now their current share price is around $14.90. However, their NAV per share, or the book value per share price, is about $15.26, which means their stock price is objectively undervalued in comparison to their NAV per share price, a 0.98. And that can mean a few things. Either the market believes that Blue Owl is fairly valued, or they're bearish towards them, or that they are, in fact, undervalued. At least they are on paper. And because I feel like some people are visual learners, you can pause the video right now. I think this would be a pretty good retirement dividend income portfolio, as I just alluded to, talking about the allocation of what should be in the mix. So for a retirement portfolio that's valued at about $1 million, the total cost, I have Blue Owl Capital. Their allocation portfolio itself is a 7.4%. However, their dividend payout annually is $8,400. Their dividend yield is 11.3%. And making up the bulk of this portfolio, I have SCHD at about 19.4%, and McDonald's at 15%, and Realty Income Corporation at about 14%. When you take all of that into account, the average dividend yield for this retirement example portfolio is about 4.4% dividend yield. And I would argue this is pretty good. This is a darn good retirement income portfolio, which means annually you can expect your dividend payout for the first year at least to be about $44,300. That's for year one. The next year, this payout should grow at a rate of 6% based on the weighted dividend growth rate. And every single month, if we break it down, you could expect on year one to get about $3,600 in dividends every 30 days, which I think is pretty phenomenal. And if you add in the Social Security income, your 401k account, if you start selling that slowly, it should be in around the ballpark range of like, what, $6,000, $7,000 in retirement every single month. I think that's pretty good. And as a man of his word, I had this in the table of contents. The next steps, how to analyze a BDC. Now that you kind of understand what it is on a high level, what a good one is, and what a bad one is in the form of prospect capital. On a high level, when it comes to analyzing a BDC, the three most important metrics to look at are number one, the NAV, the net asset value, or the book value per share over time. It's not good enough just to look at it what it is today. You want to look at it for at least the past 5 years. Maybe not 20 years or 30 years. They are no longer that same operation. So I think the past 5 years or so, you want to see a healthy upward trend over time. And then number two is the dividend profile, because the dividend itself is the result and the output, 90% of the earnings of how good their financials and fundamentals are doing. So in the case of BDCs, their dividend profile is super important. And then number three, this is really subjective, but you could also analyze and assess their portfolio quality. Like what kind of companies do they do business with? What sector makes up the bulk of their portfolio? And you also want to look at the type of loans they issue and their history in the stock market. I'm not saying that past performance is indicative of future gains, but it's going to show you a bigger picture of what this BDC has been doing. Has their share price been stable throughout the ages while maintaining and increasing their dividend yield? Or like Prospect Capital, did their share price in fact go down year over year for the past 15, 20 years? Now, if you want a full in-depth explanation and analysis on how to evaluate a BDC, you can watch my 20-minute video that's titled, What Makes a Good BDC? And we do a working example with ARK. So if you're looking at or contemplating or thinking about ARK, watch that video to see what the conclusion is. But spoiler alert, like I alluded to earlier, the three BDCs that are recommended, ARK is pretty darn good. But if you want to see the justification and how we reached that conclusion, watch that video. And I have a question for you guys. It's on the topic of laundry detergent. So I don't know if you know me or not. Hi. My name is Amos. I do YouTube videos full-time. I used to work in corporate America, and prior to that, I used to be an infantry officer in the United States Army. But as of right now, in 2025, I am a full-time YouTuber, which means my wife is the breadwinner. I'm not ashamed to admit it. It kind of sucks that I don't make much money, but it's going to follow. Because I believe in this idea that if I just keep putting out good content, I think the money is going to follow. If I just hyper-focus on the money itself, I think you guys are going to be able to tell, and my content is going to suck. However, we are slowly improving and making progress, but that's neither here nor there. So, my wife is the breadwinner, and I'm the guy that does all of the household stuff. So I'm talking about like a 1950s housewife. I do the cleaning, I do the dishes, I take out the trash, I do the laundry. And so my question is, what are you guys using for laundry detergent? Because for the longest time, for the better part of a year or so, we've been using Era, what you see on your screen right now. And in the past, dude, it used to be good. It's one of the cheapest laundry detergents you can get, but it's always been effective. Little goes a long way. However, these days, I feel like the formula changed or the laundry detergent itself went bad because, dude, it sucks. It's ass. So I'm asking, what laundry detergent do you use and do you recommend it? I mean, I want to stick with the Procter & Gamble line of products, so I have been researching Tide and Gain, but I am open-minded, and I'm hearing that Persil is really good as well, so let me know. All that to say, you made it to the end of the video. I love you, stay safe, and good luck in the stock market. If you like this type of content, feel free to subscribe. If you feel like you're getting a lot of value from this channel, then please hop on over to the Patreon and become a paid supporter. Because on the Patreon, I upload exclusive content that I don't share on YouTube. And I promise I'm not going to be some Nigerian prince who's trying to scam you. I love you guys. Talk to you next time. Peace.